Good evening, everyone, and welcome to yet another Wednesday evening webinar series. And uh, thank you for everyone who has joined in a weekday evening. And today we are continuing with the sector focus, which was done earlier also. And with the feedback that we need to understand more about many other sectors, this week we have picked up the healthcare sector, uh, primarily the hospitals and the network hospitals. And the second one is everyone's favorite, the banking sector. So, like we say, the growth in the economy has been synonymous with the banking sector's growth after the private banks came in. So there is a clearly two phases in the healthcare sector, what we typically call pre-pandemic and post-pandemic. So the post-pandemic world is very different, and healthcare has become the focus of the people's life. So be it fitness, uh, be it health insurance, or the sector in general has been continuously, getting more and more attention from all stakeholders, from the government, from the investors, from the companies. Everyone is focusing on this sector. So today we have Mr. Rushabh Duggar, who is a very senior equity research analyst, and he's also a CFA plus FRM. And uh, uh, we have to finish two sectors. We're on a very, very tight schedule. So without taking any further time, I will invite Rushabh to uh, present the sector focus, which is the healthcare.
Okay. Thank you. Thank you so much, Naveen sir. I'll
Yeah.
just share my screen. Just a
Yes.
moment. Yeah. Again, on behalf of Finnfit, it's great to see so many attendees attending this webinar. I'll be conducting a webinar on hospital sector, and Pratik will be conducting the seminar on banks. And it will be great to get some insights from doctors itself who are managing all these hospitals. It's very difficult to manage all these hospitals. So I'll just start the presentation, just a moment. Yeah. So, based on this line, quality healthcare isn't a destination, it's an ongoing journey. So, I've always learned this the hard way. So, previous year, I had an accident where I fell from the bike and I hurt my back. It was a disc slip and I injured my disc in L4 and L5. So, post that, I've started to realize that health is a really important thing to consider, and you need to protect your health by going to doctors, doing exercises, and keeping in check with everything. So that was the moment when I realized I need to focus on my health. So today, if you see hospital as a sector, it's the backbone of this economy. If the hospital sector is not there, it will create a chaos in an economy. So for example, if you see UK, the hospital sector over there is brutal. People are not getting appointments over there. People from UK are coming to India for their treatments because it's very easily accessible over here. So if you see all the NRIs, they are coming over here for their treatment uh, for the reason of unavailability of appointments, plus the treatment quality over here is phenomenal. And the third point, the cost over here is very reasonable. If you see US for that matter, the cost in India is only 20% or compared to US. So today in this webinar, we'll be focusing on large scale hospitals and why these large scale hospitals can improve further, and these companies should be in your portfolio. So this is our agenda for today. I'll just be telling you the overview of the sector, and I'll be telling you regarding the sector from an analyst point of view. So it will be great if we can get some insights from you. We'll be discussing some advantages of specialty care hospitals and large scale hospitals, some growth drivers, operating metrics, some challenges, and whether it's the right time to invest or not. So today we have gathered in this webinar to know, whether we can invest right now or no, right? I'll just go ahead. So overview of the hospital sector as a whole. So if you see from a current GDP point of view, India is spending almost around 3% of their GDP in the healthcare sector. But to be honest, it's not enough. So if you see per capita basis, it's only $56.6. So compared to other countries like US, where the per capita expenditure is around 11,000 USD dollars, and Singapore is also $3,500, the proportion is very less. So US, on the other hand, is spending around 16% of its GDP on healthcare services. So this, you can see a huge gap between GDP of India expenditure versus US expenditure. So let's talk about the healthcare delivery market. So in this, we constitute the hospital segment, diagnostic center segment, and telemedicines. So overall, it's around 5.6 trillion rupees, which is expected to grow at a CAGR of 11.3%, which is huge. If you see other sectors like auto or even banking for that matter, I don't think any sector will be able to grow at such a fast rate and at a consistent rate. Other sectors are usually volatile and cyclical in nature, but hospital is not cyclical. So these are some other factors which I wanted to discuss. So healthcare sector in India is spending around 20 lakh crore annually, but the infrastructure is not adequate for India. We have only 7 doctors per 10,000 citizens. So to be honest, cars are more than doctors as per the population. Healthcare sector is one sector which is able to employ the most amount of people, which is around 70 lakh people. And total number of hospitals in India is around 70,000, including public sector, private hospitals, primary, secondary, tertiary, you name it. So again, as per percentage, hospital is 61%, diagnostic is around 10%, domestic pharmaceutical is 20%, and medical devices is 9%. And one more thing, if you guys have any questions, you can just write it in the chat box, and Naveen sir can ask me those questions.
Rishabh, just to give a little context,
Yeah.
just
You are
move
on
to
mute,
the.
Prateek. Yeah.
Am I audible now?
Yeah, you are audible.
Yeah. So if we look at this slide, India spends
Hmm.
around $56, right, on
Yeah,
healthcare.
correct.
Whereas India's per capita GDP is roughly around $2,500.
500 crores, correct.
Yeah,
So if
and
you see,
yeah,
yeah.
United States spend around $11,700 on
Hmm.
healthcare, whereas their per capita GDP is roughly around $80,000.
Correct,
So if we take on a relative basis, India has a huge headroom ahead of us, in
correct.
terms of healthcare.
Yeah, that's why I've written over here that in US is spending around 16% of their GDP on healthcare sector, whereas India is only spending 3%. So which
3%, yeah.
so you there's a huge gap between India and
Huge gap.
US.
Yeah, yeah.
Yes.
So that is really nice to see that, So
Great.
there's a lot of
Great
scope in
insight.
this. Yeah, yeah, great insight.
100%. So if you see the split between private sector hospital and public sector hospitals, private sector hospitals is around 68% and government hospital is 32%, out of which only 12% is large chain hospitals and medium and small chain is only 88%. So we expect this large chain hospitals to grow at a faster rate than other hospitals. So in the next slides, I'll be telling you the reasons for why we expect large chain hospitals to grow. Now, let us understand hospital economics. So these slides are very interesting and it will help you understand how, as an analyst, we are analyzing these kind of companies. So again, hospital sector is providing you with stable demand. There is no sector except for defense and hospital which are able to give you stable demand. They are recession proof and they are not cyclical in nature. So because of that, these companies become good stabilizers in your portfolio. So demand for these hospital segment is unaffected by economic cycles. And there was a US S&P report that even though when there was a recession, there were stable revenues, but the profit margins declined only 3 to 6%, which seems to be a great stabilizer for our portfolio. So, do you think it's easy to start a hospital chain? What do you think, Pratik?
Looking at it, I don't think so because it requires a lot of capital expenditure, a lot of
Yeah,
medical infrastructure that goes in, and the latest
correct.
of the latest technologies that we need to get in.
Yeah. So, for hospital segment as a whole, first of all, you require a lot of capital. You require a lot of time patience. You require a phenomenal management. Then only you are able to crack this kind of business. So from this photograph, you can see that we need a lot of capital over here. So you need capital for land, building, hiring proper skilled doctors. Then you also need high capital for working capital requirements. You need a lot of approvals. So it is a very difficult business to crack. But once you are able to crack, there's no going back. The third point is long gestation period. So from this photograph, you are able to see that you have to wait for a lot of time to realize returns and gain the trust of the patients. So hospitals usually have a long gestation period and you require a long-term commitment if you're starting a new kind of hospital. So that also depends on which type of expansion you are doing. I'll go to the next slide, then you will understand what is brownfield and greenfield capex. But initial years for the hospital are usually loss-making. But after some years, the occupancy level increases. You get good number of patients, the case mix increases, and this creates good revenues for the hospitals and the margins of the hospital increases as well. So now let us understand what is the difference between a new hospital and a mature hospital. So from this picture, you can see a new hospital is like a new baby. The occupancy rate, which means the number of occupied beds in the hospital will be very low. The beds won't be occupied so much. The revenues will be volatile because you don't know when the patient is going to come to you. And in the initial years, the profit margin will be low because you have not set up the business properly. But once after 4 or 5 years, when the hospitals become mature, this is the time when you are able to earn good revenues and good margins. So when the hospital becomes mature, you are able to get good occupancy rates, which lead to high revenues and high profit margins.
So
Right?
just on this slide,
Hmm.
if the doctors can just give us an idea that how new hospitals can try and attract more business. Like, what are the qualities that a good hospital should have from a
Hmm.
doctor's POV
Yeah,
that
if
will help
anybody
us?
wants to share anything, they are happy to
Yeah,
share it. No?
please. Any and all insights are welcome.
So like Mr. Ashish Togra has shared on the chat that
Hmm.
hospitals like Medanta, which are coming to Mumbai, uh,
Hmm.
they are spending almost rupees 2 crore per bed.
Yes, yes, yes.
So
So if you see EBITDA per bed basis also, so for per bed, there is a discrepancy of 1 crore to people spending around 3.5 crores so that they are able to acquire that bed and probably after that they are able to get good revenues from those beds.
yeah, that also depends on the city and all where it.
From the, yeah, if it's a tier one city, the per bed value can be around 2.5 crores.
Yes.
Recently, the companies which we were tracking, they did an acquisition at around 1 crore per bed, 1 crore, 1 crore 10
Okay.
lakhs.
Okay.
So while analyzing hospital companies, the proportion of new versus old hospital is very important. For example, if it's a new hospital, then if you will see the occupancy level of that hospital being lower. But if it's a mature hospital, you will see occupancy rate higher, you will see approv higher, you will see margins higher. The hospital will look phenomenal. So tracking these elements become a very important trigger for analyzing the hospital segment. Okay, now let's go on to how you can expand the hospitals if you are a large chain hospital, there are two ways you can do it. Actually, there are three ways. I'll go down to the third way as well. So from this photo, you can see there are two options, either a brownfield capex or a greenfield capex. So does anybody want to share what is a brownfield or a greenfield capex? Anyone from the audience, it will be great. So shall I go ahead?
Yeah.
So brownfield capex is basically you are expanding in the same vicinity where the hospital is. So for example, the hospital has around 500 beds. They are planning to increase the capacity in the same facility, wherein probably they can add in floors, they can make more space for the beds. So because of that, they are able to scale up faster than a greenfield capex, and their break even is at a much faster rate if you compare it to a greenfield capex. So if you see in the hospital segment as a whole, 45% of this capex is brownfield because it becomes affordable for the hospital segment to do these kind of capex. Now, where we see greenfield capex being a major trigger for hospital segment. So if you are going to a new region overall, so they are not able to do brownfield capex over there because they don't have a hospital over there. They don't have their brand over there. So they have no option other than doing a greenfield capex over there. So making a brand over there requires to make a greenfield capex, and because of that, you have to engage with doctors, you have to do marketing cost, then it becomes a little expensive to, do a greenfield capex for the hospital segment. There's the third way you can enter into a new market using a greenfield capex, which is, acquiring hospitals using a operational and management model, wherein you will acquire the old hospitals, you will manage it properly, you will put in a little bit of capital, and after a point of time, earlier than a greenfield capex, you are able to generate revenues. So
So
I've just,
Rishabh, yeah,
yeah.
please continue.
Yeah. So if you see from here, uh, there are three elements over here: brownfield capex, greenfield capex in the place where you are dominant. So, for example, Apollo Hospital is dominant in Mumbai. So, if they do a greenfield capex over there, that can be an example of that, or greenfield capex in a new market as a whole. So if you see Medanta expanding somewhere in the south, that can become a greenfield capex in other market. So if you see brownfield capex, the break even is around only 6 to 12 months. And it will take only 2 to 3 years for that hospital to mature and give you proper revenues and margins. And greenfield dominant market, it can take around 15 to 18 months to break even if the brand of the hospital is very good. And for that hospital to mature, it can take around 4 to 5 years. And greenfield in a new market directly can make the break even at around 24 to 36 months. And it can take around 7 to 10 years for that hospital to mature, which is a very long period. So that's why most of the hospitals are not preferring doing a greenfield capex directly. They are tying up with some hospital or the other.
So Rishabh,
Yeah.
using our analyst brains,
Hmm.
correct me if I'm wrong. So the revenue that I will generate per dollar or per rupee that I invest in a brownfield investment
Hmm.
will be more than revenue that I will generate from a greenfield expansion. Am I right?
So this comes with the answer of you will generate revenue faster than a brownfield capex. Now, it also depends on where you're doing that greenfield capex. So if you're doing in a place where there's high demand for those hospitals, that can generate more revenue. And brownfield capex will help when there is more demand and more rooms required in that particular hospital. So if you see your occupancy level is almost full, and then in that hospital, it makes sense to do a brownfield
It makes
capex.
sense to do a brownfield. Okay, got it.
Yeah. All right. Good question, Sati.
Thank you.
So
And
now, yeah.
these two terms are quite common across industries.
Yes,
So,
yes, yes.
like Maruti was dominant in North Gurgaon, they had a major base. Then they came to Gujarat, so that was a greenfield expansion. So
And
these
yes, sir.
terms are same across all the industries, but yeah,
Correct.
here the dynamics looks much different because it's about the
Yeah,
brand name also. Maruti was anyway present everywhere.
yeah.
But in case of
So,
hospitals, it becomes a little different because the brand may not be
hmm,
known across India if they're only in a one specific region or area.
correct. So Maruti becomes like you are making a manufacturing plant over there. So
Yeah.
it's not customer focused. Here, when you are doing a capex, you have to focus on where they'll you will get more number of patients and the quality
Yes.
of patients is also good.
Yeah. Okay.
So now let us understand why we focus on large hospital chain. The first thing we focus on is these people have pricing power. They have huge number of capital, they have good management, they have good brand loyalty. Because of that, they are able to charge higher prices for their facilities. And people are willing to pay for their facility because they are getting good quality. They have a strong bargaining power with their suppliers. They are able to get equipments at a much cheaper rate compared to a small or a medium size hospital. And they are able to add beds because they have a lot of money. Simple basic logic. The second point I want to focus is on access to highly skilled professionals. Usually, because of their brand, they are able to attract top doctors in their segment. And most of the hospitals, if you see, they have a attached medical college. So because of that attachment of medical college, they are able to get uh, good quality doctors who have experience at a much lower cost because they also want experience and they'll directly get job because of that. And the third point which I wanted to talk about was diversification. Usually, if they are large chain hospital, they are doing various kinds of treatments in one place. So they offer different kinds of treatments like one hospital can have cardiology, neurology, gyno, all whatever is needed by patients can be delivered in one particular site. And because of that, you can get stable revenues and margins. So if I'm wrong, just correct me. But according to me, cardiology and neurology are high margin treatments. And if you want stable number of revenue, gynecology, pediatrics, radiology becomes a consistent revenue stream. So the
Yeah, but
second,
a
yeah,
mixed will always serve better because that will
correct.
I think in today's day and time, people are preferring large format because they get many things at one single place. People don't want to go too many places for different services. So that could be another reason that people are preferring this large chains.
Yes,
And one
yeah,
more
yeah.
thing, in my opinion, is the services by this large chains, right? So
Hmm,
when you visit a large facility, you have a sense of relief, that I'm at the right place, that I'll be provided with the right care and treatment.
yeah.
So that psychological aspect on
Yeah.
patients and their relatives also take place, and why they prefer large chains.
Yeah, so the brand quality matters. So people,
Brand quality matters,
they
yeah.
trust the brand. That's why all the patients are going. So if
Yeah.
one patient has decided to go in that hospital and it get good treatment over there, the doctors are good, they will be coming back again and again.
Rishabh, I think
So
we should also move towards the our now selection criteria and all. So
yes,
this has been really,
yeah, so I'll just be a little quick
yeah,
now.
yes.
Because of hospitals being a large scale, we get diversification benefits as per a geography. Usually, if there are any labor strikes in one facility, it does not impact their revenue or margins because they have a lot of other hospitals to generate those revenues. Okay, now let's discuss why hospital segment can grow in the future. So the first element I wanted to discuss was low bed per population. So if you see per 10,000 population, we have only 15 beds, which is very low. So if you compare it to US has 29 beds per 10,000 and Russia has around 71 beds. So there is a huge gap which needs to be filled at a faster rate. The second point I wanted to discuss was longer life expectancy. So if you see from the chart, uh, in 1950s, the life expectancy was only 35.2 years, which is increased to 70.4 years in 2023, which is expected to be 81.2 years. And most of the patients will be around 45 to 59 and plus 60 years. So if you see from this chart, the percentage of people getting older is increasing year on year. Then increase in non-communicable diseases. So these diseases are not communicable, and these are mostly lifestyle kind of diseases. So if you see from this chart, cardiovascular diseases are growing from 21%. It has grown to 27%. Cancer is growing at 10%. 2% to 5% for diabetes. So from this element, you are able to understand that because of bad lifestyle of people, these kind of diseases are increasing, and in the future, it's expected to uh, come down to 30 trillion economy in the whole world, and out of which 5.4 trillion will be from India. Again, if you see from an insurance penetration point of view, it's only 39% is penetrated from insurance in India. So once it starts increasing, people will start, coming to hospitals more for their problems and for their treatments. But their coverage is also very low as per one report. Uh, and mostly it's covered by government or a group policy. The private policy will be only 10%, which is a very low number and is expected to increase at an exponential level. And
So just Rishabh, just to add to that,
yeah,
I cover the insurance sector as well.
correct,
One metric I would like to put forward over here is the insurance premium paid upon per capita GDP for
hmm.
India is roughly around 3%, whereas the global average is 19%.
Oh,
So, we can just imagine how low is the, amount of
yeah,
premiums that Indians are paying for their health. So
True,
correct,
usually,
but
gradually
Pratik
this
and
number will
yeah,
increase.
yeah, Pratik and Rushabh, those factors are very common. If you compare India on most of the parameters, we are far
yeah,
behind.
Yeah,
So the
yeah.
important,
So
the
that's why
more
we
pertinent,
expect a
pertinent
exponential
factor
growth
is
in the
that now
hospital
people
sector.
have become more conscious of the healthcare. So the healthcare proportion will rise as percentage of the total. In any
Correct,
kind of consumption, be it hospitals, healthcare expenses, we are very far behind. So
yeah,
that
hmm.
yeah.
is the given. But here, what you're trying to understand it, the healthcare will grow faster compared to others because of these changes that are happening in the economy. People are becoming
Correct,
more aware, conscious of the fitness. Pandemic has opened up their eyes that okay, you need to take care of health and stuff like that. So otherwise, on the most of the parameters, we are far, 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 far behind.
by
Very,
the
very
way,
long runway.
Yeah, hope
100%.
someday,
Rushabh, yeah.
we match on the global level.
Yeah, yeah. So yes.
Some year after some years,
Yeah,
probably.
some years for sure.
So the
So
fifth growth trigger will be, yeah,
idea is to make them understand that this sector is basically growing faster than the others. Anyway, we are far
yeah,
behind in many other sectors also.
correct.
Hmm.
Yes. So that's why we are discussing the growth
Hmm.
triggers in the hospital
Yeah,
segment,
yes.
so that our you know investors can understand why we are
Yeah,
suggesting this sector to
yes.
our clients. Yeah. So medical tourism. If you see, it has been growing at a CAGR of 20%. It was only impacted by COVID, or else it's expected to grow at an exponential level. So the market size currently is around 5 to 6 billion, and the government is aiming in 2 years uh, for that revenue to be 12 billion, which is 2x in 2 years. And this is because of the quality of treatment again, and India being the lowest cost treatment destination. So, for example, if you take replacement in US, it's costing around 50,000, and in India, it's only $7,000. So, which is less than 15%, compared to USA. So, which is a huge gap, and that's why people come from abroad are coming for their treatment over here. So again, I think this is the most important part for listed space, at least for our clients to invest in hospital segment. So this is inorganic growth basically. So what hospitals are doing is they are acquiring hospitals which have temporary problems or are generating losses. They are able to acquire it at a cheaper price. They are able to infuse capital, and with their management, they are able to turn around those companies in a span of around 6 months to 1 year. And because of their problems, they are able to attract them at a cheaper valuation at around 10 to 15 EV by EBITDA multiple. And if you see any hospital companies, their valuation is around 28 to 35 EV by EBITDA multiple. So this brings a value arbitrage for these kind of companies. I'll just go ahead. Okay, some operating metrics which we analysts use for the hospital segment. The first will be occupancy rate. Occupancy rate is simply the number of occupied beds per total available beds. So logically, if the occupied beds are more, it will generate higher revenues and higher margins. But we also have to check whether the proportion of mature and new hospitals is at par. So if a hospital is acquiring new hospitals and expanding, their occupancy rate will obviously be lower. So you have to track that metric also. We also have APROF. So based on the formula, it's total revenue divided by number of occupied beds into 365. Its simple meaning is basically per bed, how much revenue hospital is earning every day. So from this chart, you can see hospitals earning around 67,000 rupees per bed, 77,300 for Artemis. Apollo Hospital is 57,500, etc. And the median is around 55,400 per bed.
Which is on the higher side.
Which is on the higher side, correct. So now, average length of stay. So I guess even doctors know that it's better for a patient to come, get treated, and get discharged as soon as possible. The reason being, when the patient comes, they are able to generate revenue from admission fees, from test, surgery, ICU monitoring, and most of their surgeries. So after the surgery is done, the patient comes into recovery phase. And once the patient comes into recovery phase, the revenue generated per patient is very low. So that's why we need to track what is the hospital's ALOS, which is average length of stay. So if that ALOS is lower, that means that hospitals are able to generate more revenue per patient basis. Now, let us look at capacity expansion and valuations of these companies. So if you see, almost all the hospitals are doing some kind of capex or the other. So let's take an example of Artemis. Artemis is doing 440, it has a capacity of 448 beds, which they are planning to increase to 500 beds. In total, it will become 1,000 beds. So which gives you a visibility of 112%. And based on the valuation, it becomes an attractive buy, because once the capacity is increased, they are able to generate revenue from these capacities. So
So
probably
basically, number of beds multiplied by the revenue per bed is the revenue. So higher the number of beds, higher the revenue.
higher the number of beds, higher the revenue, higher the margins, and higher
Yeah.
the profitability for
Yes.
that hospital.
So I can see
So
just 2 or 3 doubling their capacity. Others are normal 50,
yeah.
30% growth rates.
So while checking the additional capacity, it's better to check what valuation you are getting that hospital at. So it's better to get it at a cheaper valuation, plus that hospital is generating additional capacity for the future. So I can see Artemis over here with high visibility and high lower EV by EBITDA multiple. I can see Medanta over here with higher visibility and compared to other lower EV by EBITDA multiple. So this becomes a very important thing to track while analyzing those hospital segments. Now
So
let me
just
come. Yeah.
just if you could move, yeah. So me and Naveen, so we were discussing this evening that how
Hmm.
Max has the highest EV to EBITDA ratio, and
Yes.
someone has just asked that question in the chat box as well. So I would like to discuss that with Naveen sir. So
Hmm.
Naveen sir had this input that if we look at all the hospitals, and Rishabh, you can enlighten us.
Yeah,
he thinks that Max would have a very good profitability ratio compared to other
hmm,
banks, which is why
correct.
market has given it a higher multiple.
Yeah. So
So,
if you see EBITDA margin basis, Max's EBITDA margin is one of the best because it is able to get most of their patients from outside India. So I guess around 20-25% of their patients come directly outside India, leading to higher revenues and margins for that company. And once they are able to expand number of beds, they because of their proper case mix and very good clientele, they'll be able to generate higher revenues vis-a-vis leading to a higher profit margin for that company.
okay, so they have one of the best, margins and profitability into the sector, and because of
Yeah,
that, market has given it a higher multiple.
higher multiple, correct.
Got
Yes.
it. Yeah.
Yeah. Okay, now let us discuss some challenges over here. So the first challenge is insurance penetration risk. So insurance is increasing day by day. So what is happening right now is usually hospitals are price makers, but because of the increasing penetration of insurance, they have to become price takers and listen to insurance companies because they are very hard negotiators, and they tell hospitals to accept a lower rate for the treatment. And if you see, the payment terms for insurance companies also late, so they'll pay you after probably 45-60 days depending on how you negotiate with that insurance company. The second element I wanted to discuss was regulatory risk. If you see, if government thinks something bad is happening, something wrong is happening, they will intervene, and they will put extra penalty or capping for particular things. So in 2017, government has capped prices for cardiac stents, knee transplants, reducing the hospital revenue by around 70% for that specialty. So that's why it's important to diversify your treatment as well, because
So,
government can
Rishabh,
come anytime and put allegations or put penalties on your
penalties,
business.
yeah. So,
Yeah.
Rishabh, going ahead, what do you think the other diseases could be, which could see, government intervention, just like,
Uh,
we had in cardiac
Probably
stents
we'll
and knee
discuss
transplants.
that later because we are a little short of
Short
time.
of time. No
Yeah,
problem. Yes.
yeah.
Yeah, yeah. Go
So
ahead.
regulatory penalties can be charged when the hospital thinks, when government thinks the hospitals are, overcharging their patients. So there have been many penalties on Max, Fortis, and even Apollo. And if you see challenges, the number of staff members are very low. So as discussed earlier also, India has only 7 physicians and 18 nurses as per 10,000 people. And if you see US for that matter, they have 157 nurses and 26 doctors. Okay, so now we are on the last slide. Let us understand why we are telling our clients to invest in this segment. First, because income is rising, people are able to afford medical treatments, and they are going for daily checkups and solving their problems using any treatments. The second is increase in medical tourism discussed earlier, increase in insurance penetrations, acquisitions which are available at a cheaper cost for big hospital chains to take over, and increase in health awareness. So where we think our clients should invest, we think that clients should invest in companies where they are doing bed expansion, either using a brownfield capex, or it can be a O&M model, which is operational and management model, by taking up some fee from for managing those hospitals. So from FY24 to 27, we expect the hospital revenues to increase by 15 to 18%. This will be mostly from bed expansion, and a little revenue will come from AppRov growth. Again, when do you think we should invest? So I think if you just wait and think about a proper time to invest, you will always miss opportunity in the hospital segment. So there is no custom made index for the hospital segment, but if you just make a custom index using all the hospitals, you will be able to see that these hospitals are, giving 52-week high every quarter. There's no time to stop, and when they are expanding beds, they'll be able to increase revenues. That is the reason why you won't be able to get hospitals at a cheaper rate. And according to us, stock specific approach is recommended because that will give you hospitals at a cheaper valuation rather than taking a custom hospital index overall. So
Yeah.
I guess I am done for now. So
Yeah.
probably we can take questions, or we can go to the next sector so that we are able to complete the sector in time.
Yeah. Just to summarize, if somebody has any question, you can always answer. But just to summarize, what I understood from this presentation, that large is becoming larger.
Yeah, correct, sir.
So uh, we have many doctors who run their own clinic setups, hospitals, so they might have a different opinion. So maybe we can take their view
Yeah.
also.
So in the end,
But
we can
overall,
take their
that is the,
insights.
but yeah, on the industry level, that is the trend. The growth is definitely stronger compared to some of the other sectors because of the
Hmm,
tailwinds coming from the pandemic and higher, awareness on healthcare, all forms of healthcare, and the hospitals are the primary beneficiary, including the diagnostics and everything. So now hospitals
correct.
invariably have their own diagnostics in-house and all that. So if
Yeah.
anyone has any question, maybe you can take now, or you can, even answer later.
Yeah.
So uh, Pratik will start with the. So after Rushabh mentioned, one of the key requirement for hospital sector is the capital.
Capital.
Yes.
Yeah,
And
exactly.
there are two ways to raise capital, what we typically call uh, raising the capital for any brownfield or greenfield project, or for anything that any other business expansion. That comes from two sources, equity and the debt,
Right.
borrowing, what we call. And that is the reason the banking sector is very, very important, because if the economy is growing, any sector that is growing, they will need capital to uh,
Grow.
grow. And as we all know, equity is expensive, debt is cheaper. So many of these
Yes.
large companies prefer a blend of debt and equity in a manner which optimizes their return on capital employed. So
Hmm.
now Pratik will take us through some of the tailwinds and headwinds in the banking sector. Over to you, Pratik.
Uh, Thank you, sir. Good evening, everyone, and thanks for joining in late this evening. I cover BFSI, that is banking, financial services, and insurance, and defense sector for Finovate. So today I'll be covering banking sector. I'll start with a small quote and one of my favorite quote. That is, "Adventure is the life of commerce, but caution is the life of banking." So if you look at commerce, taking risk, exploring new opportunities and wandering into uncharted territories, is the life of commerce. Every day is something new. But unfortunately, that is not the case with banking, because banking, is built on trust. It is built on, good risk management, and it is built on caution. So, all of us will go to sleep tonight, we'll have a good night's sleep thinking that banks are keeping our money safe. So having that trust for a bank is very important. Having the clients and the customers trust is very important. So we can go ahead with the presentation. So the agenda for today's presentation will be the overview. We'll see at the overview of the banking sector, what the Indian banking sector looks compared to its global counterparts. We'll look at the structure of the sector. How is it shaped? What are the players? Who are the players? And what is the category they cater to? Uh, Going ahead, we will look at what has happened in the banking sector in the first half of this financial year. Moving from that, we will also look at some of the key points that has led to, the results of the financial results of the first half of financial year 25. Going ahead, we will look at the long-term growth drivers for the banking sector. Challenges, we'll look at short-term and long-term challenges for banks, and what I think could be some of the headwinds going ahead for banks. And finally, we'll move on to the question of the hour that, should you as an investor invest in this sector or not? So going ahead, uh, so if we look at the global scenario, right, global banking sector is around $4.6 trillion, right? It's a huge number, by the way, and it is supposed to grow at 4.5% CAGR for 9 years, and it is expected to touch around $5.7 trillion. So if we look at the global market, global banking markets right now, so it is roughly growing at around the global growth average, right? But if we,
Hmm.
take a little worm's eye view, we come at India. So if we look at the Indian banking sector, Rishabh, could you please move the slide?
Yeah.
Yeah, perfect. So if you look at the Indian banking sector, it is roughly valued at around $450 billion. The eye-catching number here would be the 9% figure, which is double of what the global banking average would be moving at. So, by the time it is 2032 or even further, India would have posted a better growth rate in terms of banking than its global counterparts. So, I think this is a very good opportunity. And, people who I think who won't invest in banking right now would definitely be missing the bus. So it
Yeah,
would be
if you
an,
see the current valuations also, it seems to be very reasonable and the right time to invest in banking
oh,
sector.
my God, do I hear that, a lot day on day that banking is getting cheap, banking is getting cheap.
Correct.
So, yeah. So we'll move ahead with that. Coming to the structure of the sector. So on top of the chain, we have the bankers bank, as we call it, the Reserve Bank of India, which is also the central bank of our country. So the Reserve Bank is also the regulatory body that, keeps an eye on the banking sector. That, are they managing their funds prudently? Is the risk management in place, and is everything going according to the regulatory framework or not? Uh, Going ahead, we have two kinds of banks, scheduled and unscheduled. Unscheduled banks are basically banks who are not recognized by RBI because they fail to meet the requirement criteria to qualify as a bank. So on the other hand, we have scheduled banks. Under
Can
that,
you
we have
just name a few unscheduled banks for our audience?
so unscheduled banks. There are no names. So
Names.
these
Okay.
banks are banks that are set up in rural areas in jilas. So
So
if
are
there
these
is
NBFCs by any chance or no? No.
no, not at all.
Okay.
So, unscheduled banks are banks which are not recognized by RBI at all. That, you don't
Okay.
categorize as a bank, a private bank, or NBFC, or a small finance bank.
Okay.
Yeah. Going ahead, we have a commercial banks, and in that we have a public sector banks. Public sector banks are banks, where government has substantial stake, and the stake is held by public and other investors. Private sector banks are banks where we can see investors in the form of promoters, in the form of foreign investors and domestic investors. Foreign banks are the banks who have headquarters outside India, but they do operate in India, with having their branches across the country. And we have our regional rural banks. Uh, so just moving ahead. Uh, so our focus for today will be the listed segment of the banks, right? We want to talk about how we can, create wealth. And to create wealth, we will need to invest into the listed banks. So into the listed space, we have three kind of banks. One is our private banks, the well-knowns, the HDFCs and the Kotaks of the world, right?
Correct.
So these banks, they function in a little different way, as in they target people, service class people, people like you, me, and the affluent class. So the question would be, why do they target us? Because roughly we belong to the top 5% of the country, right? So we want services. I want to have lounge access. When I'm going through an airport, I want to have offers. When I'm buying shoe or when I'm buying a laptop. So these are the, or, I want to just get my KYC done through my home or through my office. So these, curated offers, these tailored offers and these tailored services that, the bank is able to provide, that can only be catered to people who are, ready to pay a price for it. So such banks, uh, uh, take a take a wider look at people who are affluent and service class people. Public banks, their modus operandi is slightly different than the private sector banks, because they, focus on attracting customers with, attractive rates. So, Rishabh, if I were to ask you,
Hmm.
would you choose a private bank that offers you a lower interest rate but good services, or a public bank that offers you higher interest rate but, does not provide you with quality services?
Yeah.
What would you choose?
So I would choose a private bank and let my money be invested in equities.
And that's a
Simply.
very smart answer. I was expecting that
Yeah.
from you.
Yeah. So, but just wanted to understand whether the
Mhm.
public sector banks will be able to, offer you the solutions which the private bank is offering.
So, for that, right? So, what happens is, because the public sector banks, right? What happens with public sector banks? They are not very much focused, on the profitability metrics.
Hmm.
So, since government has a stake in it, they are also focused that, banking is provided to everyone.
Hmm.
Right. So even banks
Correct.
offer, the public banks offer these services, but the quality would not be as good as the private sector banks. So
Fair point.
somewhere there will be a lag, in my opinion.
Correct.
Coming to the third and the last category.
Just a second, sorry.
Yeah, no problem. Last category, that would be the small finance banks. So small finance bank, is a totally different avenue from our private and public banks. Uh, Small finance banks focus on people, uh, people on whom private and public banks, don't put their focus on. So these are the people, who are unknown, who are unbanked, and who are in the need of financial help. But because of, their low CIBIL score, or, not so stable income, private and public bank, tend to stay away from them. So small finance bank usually, finance people who have low financial needs, like, a microfinance loan. Microfinance loan is a loan whose value is under 2 lakh rupees. So if you want a, if you come from a backward class, background, and you want a loan for 2 lakh rupees, so small finance bank is your place to go. So these are the, these are broadly the different types of banks we have. In the private segment, we have our HDFC and Kotaks of the world. Public sector, we have a Punjab National Bank, we have a BOB, Bank of Baroda, and we have a State Bank of India. Small Finance Bank, we have our AU, Small Finance Bank, we have a
Yeah.
Ujjivan Bank, Equitas, and Jana Small Finance Bank.
Okay. So just a question, Pratik. So
Yeah, sure.
usually if you see a small finance bank, there'll be, low income class people going over there, which simply means that probably they'll be getting a loan at a higher rate, right?
Yeah,
Which will
correct.
probably increase the margins for the banks, but they will also have a lot of non-performing assets, right?
Yeah. So, what happens with these banks is, so if I am an HDFC of the world, right? If
Hmm.
I want to ask a deposit from a customer, I will offer a, 4% on a savings account, 6% on a term deposit. But
Correct.
small finance banks, have to offer higher rates than even public banks
Correct.
for people to keep their deposits. So
Hmm.
somewhere, if you look at the net interest margin, the final, profitability metric, somewhere it is, obviously it's, higher than private and public banks, but somewhere it normalizes because the
Correct.
cost also goes a little bit higher. And at the same time, you're taking on more risk than a public bank or a private sector bank.
Got it,
So
Pratik. Great answer.
for for most of the investors, we say that higher the risk, higher the return.
Return.
Yeah, yeah,
Banking is the only example
yeah,
where
yeah.
it may
Higher
not
the
be
risk.
true.
Yeah,
So
Correct.
definitely
higher
said.
the risk may not. So aggressive lending practices, the higher risk on the lending side may not be the very, very good choice. And in fact, one of the leading banks like SDFC Bank has been very, very prudent in lending,
Very
and
prudent.
that's the
Yeah, yeah.
reason
One of
Yeah.
the
they have
best,
created massive wealth for their investors. So
Correct.
Massively, yeah.
banking is a business where the higher risk may not result in higher
Leads
return.
to higher
Cau-
return. Correct, sir.
Caution is the life of banking, like we say.
Yes, yes.
Yeah. Moving ahead. So now we will look at what has happened in the first quarter of first half of financial year 2025, right? So if we look at the financial data for private banks, if we look at the revenue has grown at around 22% year on year. If you ask me,
Mm.
a banking analyst, I think that is a great number for private banks, amidst the deposit crunch and, the stress in the microfinance segment, posting a 22% revenue growth, top line growth is, amazing performance in my opinion. If we come down to EBITDA, has been a little muted, but there are a few reasons for that. One is that so private banks have increased their cost to attract more and more customers. So a quick data, a quick thing I'll share with you guys. If you want to get Axis Bank's credit card,
Mm.
so 10 years down the line, 10 years ago, the thing was, you have to go to the bank, you have to apply, the bank will, come back to you
Yeah.
after a week. Today, I think it takes less than 2 days, and the bank gives you 500 rupees cash. Cash. I'm not talking about rewards or anything. Bank gives you 500 rupees cash as a joining bonus. So because of these additional costs to attract more and more consumers, bank
Mm.
is increasing their expenses, and that is taking a hit on their EBITDA.
Correct.
But coming down to PAT levels, I think growing at 16%, it is a very good number for private sector banks. Second, we have a PSUs. So PSUs have also shown a year-on-year growth of 18% top line. Again, in my opinion, a very healthy growth for banking. Given that how first half of the financial year has been, the GDP rates have slowed down. Corporates are not posting profits, in line with the analyst
On
expectation.
a macro level, anybody will understand if your profits are growing at 20% per year.
Yeah, yeah.
Considering the first half numbers, it's a good, it's doing, everything is fine.
It is. Yeah, everything
Correct.
is
It's a
fine.
Mm.
strong sector. It's a strong undercurrent. 20% PAT growth is very, very high. Considering on an
Yes.
economy level, we are growing at say 8% GDP plus 5% inflation, 12, 13% average. This 20% is quite a high number.
Yeah, so this is because RBI is keeping a close eye on banking.
Hmm.
So any bad move from any bank, and they just punish them right away. So there is a
Correct.
no zero tolerance policy from RBI's end, and that is that regulatory threshold is keeping banks in line. And
Yeah.
uh, in result to that, we are seeing healthy PAT numbers.
Yeah.
So if we going ahead, if we look at the overall banking sector, right? If we combine the private and the PSUs, the revenue would be around 19%, and the PAT growth would be in line at 18%, which I think is a very healthy number. Uh,
Very
you know,
healthy.
Yes.
and I think going ahead, banks can do more and more on the top line basis, because credit demand, I don't think it's going to stop, right, sir?
Yes. 100%.
The demand for credit, the demand for loans, to fulfill different aspirations, be it retail loan or be it a corporate loan. Everyone is going to require
Yeah.
capital, to fulfill their aspirations. And because of that, credit growth is the key for banks going ahead.
Yeah. So
Mm.
maybe like Rusha was saying that the if you have a hospital index, it would be almost at the 52-week high.
52-week high. Correct,
My
sir.
guess is looking at this profit numbers, profit growth numbers, is
Yeah.
the banking sector also on the higher side compared to the overall market?
No, that is the thing that keeps me at night. That is the thing that keeps me excited about banking. Is that if we look at the if we look at the bank nifty, right?
Mm.
So bank nifty is trading roughly around 2.4 times its price to book
No,
multiple.
no, no. I'm saying from 52-week high. Suppose market is corrected, say 15%, has the banks
Yeah.
Okay.
corrected much lesser?
So
No, so
it brings
yeah,
a
yeah.
very big potential for our investors to earn return in the banking
Yeah,
segment,
yeah.
Yeah.
basically.
So,
Okay.
answering Sir's question, so what has happened is banks that have, been prudent been prudent in their lending practices, banks like Axis and HDFC have not seen a bigger hit, compared to banks like RBL and IndusInd, who kind of, went with the, they went with the flow. They kind of compromised on their lending practices. So such banks have taken higher provisions, higher cost quarter on quarter basis, which has led to lower profitability. So if you look at such banks, they have fallen more than the bank nifty and they have fallen more than the nifty levels. But if you look at blue chips, who have maintained that quality of lending, have not seen a substantial drop in their prices.
Correct. So if you check out the first slide, we were expecting a growth of around 9% from the banking segment. Here we are getting a revenue growth for the banking sector at 19%. So seems to be a very good number for this half of the year, and probably the next years will be better growth than expected as well.
Definitely, definitely. It will be it will be more going ahead. The growth is, like Sir said, if the country has to, if we aspire to become a 20 trillion economy someday, banking are the legs that are going to take us there, right?
Correct.
Yeah. Now I will present you some things that, caught my eye in the first half of FY25. Uh, just one click ahead, Prashant.
Yeah.
Yeah, yeah. So one of the things is that the deposit growth for banks is slowing. So historically, the scenario is that the credit growth, that is the loan growth for a bank, and the deposit growth should go in line. So if it is going in line, so in a layman language, everything is going all right. There is no hiccup in the economy. But if we see, roughly around May 2024, the deposit rates, the advances rate have kind of taken over the deposit rate. So, to explain it to everyone, the demand for credit in the country is going up, whereas the people who are ready to put their money into the deposit account are decreasing. So,
Correct.
it is a challenge for the bank, right? If I am a bank, I want to lend Rishabh, 100 rupees, and Naveen sir is not ready to give me his 80 rupees. So I'll be, stressing out, right? So that is the scenario happening with banks right now.
Because Naveen has become very wise. He
Yeah.
If
Yeah,
he
yeah,
puts
yeah.
money in mutual funds, he earns a compounding return
Yeah.
of 15-20%. And if he keeps that money in the bank deposit, then he earns only 6-7%, 8% maybe.
Correct.
And that doesn't beat inflation. So I feel thanks to people like us, there is a
Yeah,
very
yeah,
big financial literacy, and people are understanding the power of mutual funds and equity over
yeah,
fixed deposits.
Correct.
yeah. All thanks to Finovate. Banks like me are losing sleep, losing my night's sleep. So going ahead, second thing I would like to focus on is the asset quality of banks. So even though, the microfinance segment, if we were to see, that has taken a hit in the second quarter, the overall asset quality on the sector level has remained flat. So that is a very good sign that, banks are still maintaining that asset quality, that prudent lending practices that, that are required, the standard that is required by the RBI and the industry itself. If we look at banks like HDFC and Axis, like I mentioned, they were affected the least. So if we look at their, their stock price compared to their 52-week high, I wouldn't see a very much bigger fall because HDFC has maintained one of the best lending practices in the industry, followed by Axis Bank. At the same time, if we look at other lenders, who kind of got greedy during this situation, were IndusInd and RBL, who kind of, took the adventure route rather than the caution route. So because of that, they have taken a hit because what happened was they lended more than required to the customers, which led to over leveraging for the customer. And once that happened, the customer was not able to pay their loans, which led to non-performing assets, and which eventually led to lower profits for the banks.
So it becomes very important to check the risk management policies of the particular bank and who they are giving the loan to. So if it's a
Exactly. Yeah,
proper
yeah.
good borrower who is paying the money, then it's very easier for the bank to, get money from them.
Yeah, yeah. It is very important to evaluate the paying capacity of the customer, if he'll be able to pay back or
Okay.
no. Yeah.
Yes.
Going ahead, the third thing that caught my eye in this first half of financial year was the CASA ratio. So CASA ratio for just to brief off, CASA is the term for current account and saving accounts. So just to give a quick example, if I am a bank, if Rishabh comes to me, asking for a deposit account, if he were to open a saving account, I were to give him a 4% interest rate, and I would lend it to Naveen sir at 9%. Whereas if he comes to me asking for a term deposit, I would have to give him an interest rate of 6%. And I'll lend to Naveen sir at the 9% rate itself. So what happens is CASA is the cheaper source of funds for the bank compared to term deposit. So, the higher the CASA ratio for a bank, the better it is for a bank. Uh,
Mm.
just for insight for our viewers, Kotak Bank has the highest amount of CASA, like highest percentage of CASA industry wide.
Great insight, Prateek.
Yeah, so it is roughly around 47%, 47 to 48%, which is higher than the industry average.
Great to hear that.
So in
Yeah,
short,
so
the
it's a
CASA basically lowers your cost of
cost,
borrowing.
Cost
cost
of
of
borrowing.
borrowing, yeah, and
Even
eventually
banks have to,
increases
yeah.
profitability.
So in here, the even the banks have to borrow because that is how they lend. So
Yeah.
Yeah, that is the whole business model of a bank.
model, yeah.
Yeah. So yeah, going ahead, discussing the long-term growth drivers for a bank, right? The first and foremost thing, that will drive the banking sector's growth would be the country's GDP growth.
Mm.
Like I said, that if a country country aspires to become a $20 trillion economy, it will go nowhere without the banking. Banking is the bedrock on which the economy will be built, in the future. So if we look at the GDP numbers, banking right now, contributes 7.7 percentage to the country's
Mm.
GDP, and it is poised to expand to around 8.8 percentage. Right. So this is a great insight that banking is making more room for itself in the country's GDP portfolio.
Mm.
The second important point here would be sectoral expansion. Like Rushabh mentioned earlier, that hospitals need to expand capacity. So I'm assuming hospitals won't have such amount of cash under their bed, right? Uh, so they would have
Uh, yeah, correct.
Yeah, so they would have to come to the banks to borrow at a reasonable rate. And this is how banking will generate more and more business. Not just hospitals. You take IT services, you take manufacturing, telecom. Anyone who wants to expand will have to come to banks for the fund purposes. Second would be the financial inclusion. If you were to see what has happened in the last 10 to 11 years, uh, the government's vision for everyone is that everyone should be included in the financial database of the country. So what the center's vision right now is that whatever income that everyone is earning, whatever expenditure everyone is having, should be should be taken into account, matlab, should be digitalized. So with that, we can generate insights. So government is coming up with a lot of schemes, right? Like the PM Jan Dhan Yojana, we have the PM Awas Yojana, the National Infrastructure Pipeline, and many other initiatives by the government. Just a question, to the viewers. Any idea how many accounts PM Jan Dhan Yojana might have added in the last 10 years? New bank accounts. People who never had access to bank accounts earlier. Any rough estimate would be welcomed.
You can write it down in the chat section as well.
Just breaking the silence, it's 53 crore accounts, bank accounts.
It's huge.
Yeah, out of a population of 140 crore people, 53 crore people never had a bank account earlier. And because of PM Jan Dhan Yojana, these people were able to have access to bank accounts. So we can just imagine that, once these people start, uh, using these accounts for their consumptions, for their savings, the amount of revenue and the amount of asset base that it will generate for the banks, it will be humongous. Going ahead. The third growth driver would be urbanization. So urbanization is supposed to, take a steep curve in India. Around 40% of the Indian population is supposed to be living in urban areas by the time it's 2030. People might ask me, how will urbanization help banking? Hypothetically, I am a migrant from a rural area. I come to an urban area like Bombay, find myself a job, get myself educated. The first and foremost aspiration that I will have, that I'll buy a house for myself. And, it is not easy for someone to buy a house, someone coming from a modest background. So I'll have to take a home loan, right? I'll have to take a home loan and, so that will help the banks generate more business. Going ahead, if I aspire to have a car, a bigger car someday, I'll again take a car loan that will, generate business for banking. Going ahead, if I have kids someday, I'll have to, I want to send them to, send them for foreign education. So I'll take an educational loan from the bank. So any type of loan you want, any, positive aspirations that you want to fulfill in your life, you have to somewhere down the line come to the banks, right?
Yeah.
The fourth and the last, important growth driver is digitization. 10 years, ago, if you were to say, if I were to check, I want to check my balance in my bank account, I have to go to the bank, I have to, update my passbook and then come back, right? Today, that is just possible on, fingertips, right? I can just access my statements, I can access everything just on the basis of a few touch. So, you know, this might look like a small milestone, but it is a huge achievement for a country where 1.4 billion people reside, right? To just to give an imagination, the amount of UPI transactions that were happening pre-COVID and the amount of UPI transactions that are happening post-COVID, there is a huge uptake in that. So that tells us that digitization how important it is. And banks nowadays are being the data centers for the country, right? Take any bank, they will have total data on your spending habits, on your saving habits, and they can optimize that to give you tailored solutions, which the private banks are very good at doing. So I think digitization and technical adoption would be one of the most looked after growth driver going ahead for the banking segment.
So in my FRM curriculum also, where we used to see, how the credit models are made, wherein in those models it was said to be who will get a credit card loan or no. Now they've started using AI and ML for making those models.
Yeah,
So you can see, the future is just started now, and AI
yeah,
and
yeah,
ML are a
yeah,
very major boost for
exactly,
all the sectors, not only for
exactly.
banking, for every sector.
So what banks is doing right now? So what the current scenario is? When I apply for a loan, right? There is a officer, who is checking my background and everything. That am I eligible for a loan or no? So going ahead, banks are looking forward to make this whole process AI integrated. Like based on my past spending data, saving data, and other data information, the AI will tell the banks that, should I be eligible for this loan or no? So that is going to be a very, big change in the banking sector overall, on an overall level.
Very insightful, Pratik.
Thank you. Coming back to, challenges for the banking sector. So one of the short-term challenges, that I see, coming ahead of us would be the RBI's decision to cut repo rates, right? Uh, for just a little bit of context, 68% of a bank's loan book, roughly 68 to 70% of a bank's loan book is linked to the repo rate. So if the repo rate goes lower, the bank's ability to lend at a higher rate also diminishes. The bank will have to then, lend at a lower rate,
Hmm.
which will, take a turn on their profitability. So if I was able to, lend at 9%, I'll have to lend at 8.8%, whereas the cost of deposits are staying the same. So the margin is kind of contracting in between,
So which will lead
but
to a lower profitability for the banks,
lower
right?
profitability, yeah, for the bank. But Rishabh, the thing is, it is a cyclical thing, right?
Hmm.
Rates go up, rates go down, right? So banks are very well positioned right now to, to welcome this rate cut. And I think, one of the best times to, invest in banking is, before a rate cut, because everyone is anticipating that profitability come ho jayega.
Hmm.
But if you take a longer picture, overall it kind of
Yeah.
normalizes.
Yeah. So I think this is the right time to get into banks, right?
Yeah, perfectly right time. Uh, so some more challenges that I have seen is, there is a decrease in the urban spending. People like, you and me, we are spending less compared to what we were expected to spend. I would say the reason behind this is, I would also give the credit to banks for this because banks over leveraged the customers in the second half of FY24. So because of that, people were spending more than they should have, right? And because of that, the realization of that came in the first half of this year. So what consumers have done is they have kind of, decreased their spending
Hmm.
just to normalize on the overspending that they did on the uh, second half of the last year. So this is the normalization thing, and it is a short-term kind of a bump, and I don't think this will sustain long. I think the growth in the second half should look as robust as the first quarter or the fourth quarter of the last year. Because of that, it just intrigues me how everything is linked here, right? Because of lower consumption, right? People were
Hmm.
consuming low, right? Uh, the auto sales were down, the cement sales were down. People were not buying homes and everything. So because of that, on an overall level, there was low consumption, and because of that, the corporate profits also took a dip. So, the double-edged sword of, lower corporate profits and lower consumption led to a temporary dip in the GDP.
Hmm.
So as the bank kind of normalizes their lending practices, banks like IndusInd, RBL, and other microfinance banks, they kind of become more prudent in their lending activities. The consumption will come back. It will definitely come back, which will also lead to higher corporate profits. And again, the GDP growth prospects will look brighter than ever for us. Coming to the last challenge, higher provisions. So provisions is the amount of money, right? The bank
Hmm.
has to keep aside in order that someone does not pay. If I am a bank, I cannot be like I lend 100 rupees and I expect 100 rupees back from the customers. That's not fair, right? I have to at least keep 2 to 3% as a provision. That is my cost, as such of doing business, of doing the lending business. So what happened was, in the first half of the financial year 25, the provisions just shot up. Why? Because more and more people were defaulting on their loan. Most of these people who were defaulting belonged to the microfinance segment. People who had loans under 2 lakh rupees. they were defaulting very much. And if someone asked me what the reason was, multiple reasons. The Lok Sabha election that took place, the heat waves that were taking place in the month of April. Uh,
Mm.
After that, the migration issues that were happening because of the elections. Everyone going back to their hometown to vote and everything. This led to lower efficiency of the workers, which led to lower pay and which led to them defaulting on their over leveraged loans.
Yeah, Pratik. Now we should try to summarize this with the
Yeah,
Yeah,
timing.
yeah, sure, sir.
Yeah, yeah.
yeah,
Yeah, sure. So, coming back to the, question of the hour, should you invest in this sector? I would definitely say we should invest in this sector, because, like I said, if India is to aspire to become a 20 trillion economy someday, and I hope we do that, banking are the legs that are going to, carry us there. Second thing is, bank compared to other businesses have a very stable source of income. Someone buying a 30-year loan is going to pay its premium month on month. So it's a very stable and recurring form of income rather than cyclical income.
mm,
Third is that banks are overwatched by the Reserve Bank of India, which is also their regulatory body. So most of the banks, try and maintain to be as prudent as they can, in their lending practices. Where to invest? We should invest in companies. The first and foremost priority we should have is to find companies that have prudent risk management and better asset liability matching. Banks like HDFCs and Axis of the world, do it in the most, in the best way, if I were to say. Management is very important. We should look for companies that have, management who have had a ethical and professional track record. People who have, experiences in the banking for, as long as you can imagine. On the financial point, financial statement point, one thing you should consider is the investing in companies that have given higher ROE, return on equity, and higher return on asset compared to their industry medians, right? And companies that have lower cost to do the business, the companies that have lower gross non-performing assets and net non-performing asset. When to invest? So I don't think there's a better time to invest, than now. One, because we can see the growth drivers, how the country is positioned to grow, and how banking will grow with it.
mm,
Second would be its cheap and attractive valuations to me. If I look at some blue chip stocks, which have good lending practices, which have, prudent lending practices, which have quality management and a low amount of non-performing assets, and they're also available at cheap and fair valuations. So, which makes them a very attractive, destination for investments. So, just the last point, having here a look, the bank nifty is currently trading at 2.4 times the book value, uh, which is lower than its median book value of 2.7 times. So if we look at the overall banking is only trading at a discount. But even in banking, there are some very deep pockets, that we have in the private lending space. So which would be an ideal destination for our investors.
great,
So,
Pratik.
yeah, with this, I conclude my presentation. Question and answers, feel free to ask any questions, and all the feedbacks are welcome for me and Rishabh.
Yeah, just wanted to thank the audience once again. At 9 p.m. everybody, started and they are still here with us, listening to our,
Yeah,
uh, sectoral information and our theories. So, thank you, audience, for staying up till now.
And also the standard disclaimer that
Mm.
these are the sector analysis is not a stock specific recommendation. So
Yeah.
yeah.
So, yeah, the
So
questions,
basically
if you have
these
any
like
questions, so,
yeah, like both of them pointed out that these two sectors look promising with
hmm,
certain kind of data sets and tailwinds that those sectors are into. But still, narrowing down to a stock is another level of exercise, which our analysts do all the time. Yeah. But
correct,
this
sir.
was to give you a broad picture that how so you as an investor might be wondering what is that these analysts do in the background to give a
Hmm.
buy, sell, hold kind of rating. So these are some of the in-depth. So the actual analysis is much deeper. It's just the overall summary of what work they do. And in a nutshell, they presented you the data. Hope you find all this useful.
So if we were to, put all our data into one presentation, the presentation for that particular sector would be around 40, 50 slides easily.
Yeah, so
So
that
we had
is
to make it
the
very brief.
yes, yes. So yeah. Anyone has any question, they can also put us separately. We can also help you connect with our team and get your specific queries answered. And
Yes.
yeah. Any other question, feedback, or any sectors that you want us to cover in the next presentation? Any thoughts?
Thank you so much for your feedback,
Yeah, yes.
Ashish.
So thank you very much, Ashish, for your feedback. This helps us, improve more and more on our work. Thank you for kind words.
So I would just like to thank everyone at the end again one more time that your participation gives us encouragement to bring new topics for our Wednesday series. And as we had mentioned earlier, that this is purely for learning and education purpose. There is nothing else. It's just purely we focus this. We have devoted this time only for this purpose, and most probably will again see you soon. If not next week, we'll announce it on the different social media channels. Where so Pranab, can you put up the slide where people can follow us and join our webinars? Do we have a slide on that?
Yes.
I'll just stop sharing.
Yeah.
Yeah, I think we can post the chat link
Hmm.
where people can
Yes.
join our community where we continuously post about what upcoming learning sessions we have.
Okay. Thank you.
Thank you so much,
So
everybody.
yeah.
Yeah, thank you everybody, for keeping up with us at 10:30 in night. Thank you, Naveen sir, for hosting us. It was a wonderful opportunity.
Yes.
Yeah, and team has posted the community link in the chat box. So you can join us there. And there are many more conversation happening over there across personal finance space, including stocks, mutual funds, and many other products and services that we offer. Thank you. Thank you, everyone.